court order.
The Money Show. Personal finance.
Okay, so I need to lighten this up a little bit. I'm very cross. Because it's personal finance, I'm feeling an idiom coming on. Where does the term going Dutch come from, Warren Ingram?
I actually have no idea.
But you're the ultimate cheapskate. I know you accuse me of being a cheapskate.
Come on.
Going Dutch, we know it means splitting the bill.
Yes.
Okay.
No, what it is, I don't know how. I don't know how it got there.
It's a typical...
Are you going to tell me?
Yes, it's like people like Boris Johnson 300 years ago came up with these sorts of terms, and it's typical British racism towards Europe. It was during the Anglo-Dutch Wars. They began in the late 17th century, and these guys were at war with each other on and off for decades. A number of English idioms sprang up that used the term Dutch in a negative way. Dutch courage, to have a drink, for example. To go Dutch, or to have a Dutch treat, is to eat out with each person paying their own bill. And it's a stereotype of alleged, apparent Dutch frugality. I've got some lovely Dutch friends who are very generous. Actually, I've always picked up the bill. Maybe it's true. I don't know. But that's where the term going Dutch comes from. On that point, let's talk fees. How's that for a segue?
But I just can't understand why being frugal is a bad thing. It seems to me to be a virtue, not a problem.
Yeah, there's frugality and there's being snoop.
Exactly.
And
okay,
I think if the British knew what being snoop meant, they would have said something about that. But now they just call it a Dutch treat, and the Dutch treat is no treat at all. You treat yourself, but the person with you treats themselves.
I think it's a dumb saying then. I think it's absolutely fine. There's nothing wrong with it.
I told you were a cheapskate. Now listen, on the cheapskate note, how many layers of fees are there in a typical investment? I mean, do you want to pick one investment? Do you want to pick a unit trust, or do you want to pick a retirement annuity? I don't know. You pick the investment.
So, let's look at a retirement annuity, and maybe at the same time, because it applies equally, a living annuity, and it seems to be the ones that are under the microscope a bit at the moment from retired investors. So maybe can I change my mind and say living annuity?
Living annuity, fair enough. Okay.
And typically you will find if you're looking at a normal unit trust-based living annuity, you will pay 3 levels of fees, and I'll explain what a unit trust-based living annuity is. In terms of the fees. So in the beginning, you get this vehicle, and the vehicle in this instance is a living annuity. So it's like a glass. The glass has to hold something, and in this instance, it holds a collection of unit trusts. And then you're going to pay an advisor who will typically tell you what unit trusts should be in that glass, which in this instance is your living annuity, and therefore you're going to pay an advisor as well. So there are going to be 3 very distinct layers of fees. And so, for example, a lot of the unit trust companies have gone out and launched their own living annuity because it's a very regulated, very controlled, vehicle, and the law decides exactly what can and can't be in there, and how and when you can access your money, and what the tax benefits are. So that has a very material and direct cost, because there is a life assurance license you have to buy, you have to service that, you have to control the regulations around it, report to SARS, etc. And typically that will be your first layer of fees. And if I look at what goes on in the industry, those fees typically start at about 0.5% a year, 0.57 if you add VAT, for most of the unit trust companies out there when you look at their administration fee. And the jargon will either be platform or administration. That's typically the name for that fee.
Okay.
And then you get the next one, which would be the cost of the underlying unit trust. So the actual unit trusts that you now throw into this living annuity, and that will range anything from about 0.2% for a very low cost money market unit trust, up to funds that cost as much as 3.5% or even 4%. For funds with a very high equity allocation, where they charge them they charge these exorbitant performance fees.
I mean, in order to charge somebody 4% to manage their money, you've got to get to inflation, which, let's be generous and say it's 5%. You've then got to get to at least 9% performance. You've got to make at least a return of 9% in order for your client's money to retain last year's value.
Agreed.
And then you've got to add on another, 5% on top of that to make it worthwhile paying the 4% fees.
Yeah.
And then you're getting returns of 14 or 15%, which in normal markets is fine. But you've got to be doing some pretty funky stuff to be able to achieving that, surely.
In this environment, you would have to be incredibly lucky, a serious genius, or a complete crook.
Or do flick-flacks backwards, blindfolded with your hands tied behind your back.
Well, that's the serious genius. Yeah.
Yeah. Okay.
So and I think a lot of those are would be fund of funds that that are charging performance fees all the way through, and you look at all the layers of fees, and suddenly you get to that 4% level quite quickly. And I'm not saying it's good, but that's how it arrives. And then you haven't even paid for the most important part, in my biased opinion, is the advice fee. To the advisor that's now recommended these. Hopefully not the fund of funds, but anyway, the advisor fee, and that will typically be in the region of let's say 0.2 for extremely low advisor fee to 1% for the largest advisor fee. And
arguably 1% is more usual than 0.2.
Definitely, yeah, definitely. Okay. So 0.2 is, really for very large portfolios.
So you can have, so you've got a cost here of R5.57 on every 100 Rand you invest.
Yeah. And that is the worst of the worst. I think sure. If I have to look through the average, it probably ranges to it probably goes from about R2.50 to R3 for every 100 Rand that you invest in the unit trust space.
Okay, is that reasonable? Is that a fair price?
The 250 to $3 is okay. And I would always like it to be closer to 2. But 250 to 3 is okay. So anywhere but from 2 to 3 I think is acceptable. I have seen, if we jump across now and we say this is now the unit trust world where these fees are extremely transparent. It's very easy to understand them, even uncomfortably so for those that are really charging very high fees. But the one that still bugs me quite a lot is on the other side. Then is the life assurance companies. When you go and you buy your life assurance company, living annuity or RA, and you try and understand the layers of fees. Then I think that's the one that's much more difficult to understand. And I think there, I wouldn't be surprised to see 3 to 6 Rand per 100 as a range.
For us schmucks who are caught up in trying to invest for an uncertain future, and trying to maximize returns over an extended period of time, and having some of those returns eroded and corroded by inflation and fees, it feels like the odds are stacked against you.
Yes, and I think that especially now when returns are just incredibly low, and the stock exchange is really, I know in the last couple of weeks it's been nice, but over the last 3.5 years it's done nothing. And so suddenly these are, there's a lot more attention being focused correctly so on these fees. And I agree. I think at the moment, as you were saying, the portfolios almost have to run just to stand still. That's not even getting ahead with inflation. That's not even, trying to actually generate proper above inflation growth. And suddenly, those that are paying the high fees, in the past, most people wouldn't have worried about it because the markets were great to us, and we would just carry on and say, it's not too, whatever it is, maybe a bit high, but so what? And now, all of a sudden, if you are paying 4 or 5% a year, and the JSE's given you, very little or potentially flat, then suddenly your investment might be going backwards.
Okay, so without doing the standard, let's revert to exchange traded funds, is there a way of cutting out the fees? If you want an actively managed fund, if you want a fund manager to blame in your old age, you want an individual whose face to pin to a dartboard to blame, it's not going to help, but you want somebody to blame, is there a way of cutting out these scary fees?
Yeah, I think there are a couple. So one, don't be afraid to shop around from one platform to another. So in other words, look at transferring your RA if it is costing you a fortune in administration fees. I think typically the administration fees, the only way that I've found that you can lower them, because the companies that offer these just won't negotiate on administration fees. They'll give you a tiered fee structure. In other words, if you invest the first $1 million, it'll be 1% or 0.5%, let's say, and the next $1 million will only be 0.2 or something like that. But that's it. There isn't really a negotiation. So the only way you can reduce that cost is typically if you're buying your living annuity from unit trust company A, and you go and actually use their own unit trusts, because they'll often offer you a range of funds from a range of different companies. But if you use their own funds, then they'll charge you nothing for administration. So that's the one thing to look at. Obviously, you need to be convinced that the fund is good. And then looking at the fund costs, really focus on whether your fund is a fund of funds or just a normal unit trust. Is it an index tracking unit trust? And just understand those costs. And what I've seen from some pretty dodgy advisors recently is, when their clients start asking them these questions about fees, they say, don't worry, we can drop your fee to 0.2 for your fund by moving them into a blooming money market fund, which is infuriating. I mean, that's just really horrific advice. And then the next one is your advice fee. You need to sit with your advisor and say, what is your fee? And I mean, hopefully you know what your fee is going in, but is it reasonable? Is it fair? Am I being rewarded for the advice that with the advice that you're giving me? And you need to be comfortable as the investor that you are. And if you're not, then that's a quick one to cut is an advice fee. So to me, you can make changes and you can be proactive in the situation.
And for anybody who's trying to figure out, well, it sounds like a lot of effort. Why does it matter? Every percentage point over 30 years, over 40 years, does matter, surely.
It does, and in the last sort of 3 years, if your investment has grown by 4 or 5% a year, and I'm talking about a balanced type portfolio in that living annuity space, you've done relatively well compared to people who are standing still or going backwards every year, and that's where that's the difference between comfortable retirement and real compromises in your living standards.
Warren Ingram, Galileo Capital, not happy listening. I don't think it was happy listening, but it's important listening. Listen, I'm getting lots of questions about offshore and the cost of investing offshore. Can we do that next week?
Yes, sir.
Lekker. Warren Ingram from Galileo Capital.